Welcome to Nirma Bang, ladies and gentlemen. I'm Hito Datia. We have with us Mr. G Kannan, former MD at SBI, joining in. Welcome to the show, Mr. Kannan, and always a pleasure to speak to you and get insights from you. Mr. Kannan, my first question coming to you is right now the hottest topic that everyone's talking about is with regards to, Russia-Ukraine crisis. How big an impact could that be to the banking system of India, firstly?
Here, frankly speaking, with Russia, we have got mainly a lot of imports, and the payments have to be made for various items like defense, etc. So banks have an issue about making payments. In case they make the payments in US dollars, as in view of the sanctions, they will not be in a position to make the payments, because if the payments are made into a Russian bank's account in New York, the same will be frozen, and therefore they will not be in a position to make payments. So basically, it's a question of the remittances which happen between the two countries, which will get affected. Similarly, the Indian exporters cannot submit the bill to the bankers, and the bankers will not be in a position to process it, because if the money is going to be received in hard currency, which is basically US dollars or euros, the same could be frozen by on account of the sanctions. So these are all the issues which I face. If you remember, in the 80s and 90s, we had what is called a rupee ruble arrangement, where any payment which has to be made by India to the Russian exporter was made in Indian rupees, and similarly, any payment which has to be made to India from by then was made in rubles, and the amount was kept in the Vostro accounts and Nostro accounts in the respective countries. But after some period of time, we found, because India's imports to India was very high, and therefore, subsequently, there is some relaxation in the with Russia or with the post-USSR, and then the entire thing had to be converted into dollars, and we made the payment. If you recall, we had similar arrangements with Iran when we had to make purchase a lot of oil, and Iran was also subject to sanctions. And an account was opened with one of the banks which did not have operations. In addition, what happens is, suppose you deal with Russia, and the sanctions are there. The US operations, the European operations could also get affected of the Indian banks. So banks are a bit wary to take decisions. This is not a recent phenomenon. It's been there for some time, but now it has become much more strict post the Ukraine war, or what you call the attack on Ukraine by Russia.
Right. So overall, I mean, are there any major risks that could balloon from here on for India?
See, the major risk is going to be, which we are already facing it, is the oil price.
Correct.
Oil, we are already seeing it above 100, which has been below 100 for the last 7-8 years. And we are very comfortably cruising along. Now you're going to have oil at 110, 115, 120. And with the rupee also weakening. So it's going to be a double whammy for the Indians, and in the sense, transportation costs will go up, and therefore the input costs will go up, the raw material costs will go up. So overall, it could be a major impact for countries like India. We had really a honeymoon period of 6-7 years, and now that issue will be there, and that particular problem of oil is something which is there. In addition, we also have got good arrangements with Russia for import of defense equipments. And how that impacts the Indian economy, in the sense that's an arrangement which is going on for a long time. But now with this sanction, how that will pan out, it remains to be seen. Of course, the government and the RBI and the bankers are all working together to find some solution. But this is not going to be a temporary one. It's a long-drawn affair. And even if the war gets over, I think may be some time before the sanctions are lifted. So this is going to be a major impact on the Indian economy, especially the oil impact. Other than oil, we do have some chemicals which are imported from Russia. We have certain machineries which are imported from Russia and defense equipments. So our exports are some pharmaceuticals and a few other things. One more thing is also the many students from India have studied in Ukraine, Russia, especially the medical facilities are supposed to be good. That's also going to be a question mark for many of the students. So all those students who have been there for only 1 year and 2 years and they come back might have faced some uncertainty.
Right. So overall, with all of this, if you see in terms of where the Indian banking system is concerned, it seems that we are moving to a more stable system. Is that something that you would agree with?
Again, we are moving toward more
a stable banking system. Probably a couple of years ago, you had a lot of instability coming in there from an, asset quality perspective, from what the optics look like. But here, now you're seeing a lot of stability emerge.
Okay, let me answer you this in a different ways. You're right. The focus on the banks and the NPS has come down, mainly because we have taken care of everything post the 2016 AQR of the Reserve Bank of India. And by 2018-19, I think everything has been accounted for. That is one reason. Therefore, there's no fresh bad news to the banking system in large numbers. Having said that, there is one concern which is there's no actual credit growth in the economy. Credit growth which is happening only in the retail sector, in the SME sector to some extent. Maybe now the housing sector, post the pandemic, there is a boom, therefore that will be there. And related what you call industries like cement, etc., will be there. But if you have noticed in the last 4 years, what's happened is many of the corporates have actually been underutilizing the limits and they have deleveraged. So with the result, they are not having any stress on their books, which is a very good thing for the banking. But at the same time, it also speaks that because of the deleveraging and the poor utilization of limits, the bank's credit growth is almost muted. And therefore, unless the credit growth really happens in a big way, you're going to have the banks having a flush with liquidity, but with not many avenues to deploy. And of course, it suits the government, it suits everyone, because the government can attract funds at very cheaper rates to meet their own expenditure. But the economy growth will happen only when credit expands in the industries. And hopefully the new, what's called the DFI, which has been launched with the support of the government, if that starts cracking, maybe the economy will start to, but I see muted growth in 2022-23, maybe in the second half and of 22-23 and maybe 23 onwards, you'll have a good growth in credit. And as I told you, there's no fresh NPAs in large numbers. The NPAs in the retail are small amounts. It could be large number of small tickets, but nothing which is really alarming.
Right. So in fact, when you touched upon the point of credit growth as well, yes, the credit growth in terms of banks is muted. However, a lot of agencies, research houses are anticipating a double-digit credit growth from this financial year onwards. Is that something, do you think, is achievable?
Here, double-digit credit growth is not something which is impossible, but that has to be supported by a large industrial credit growth, which I don't see much right now. And there's a good credit growth, as I told you, in the retail sector. The cost of operations have gone up everywhere. Even vehicles have gone up. Vehicle costs have gone up. Therefore, the vehicle loan will go up. Cost of education loan will go up. Cost of houses have gone up. Therefore, housing loans will go up. Construction costs have gone up. The construction will go up. But the manufacturing sector is still, I'm told, almost slightly below the full capacity. So it has to reach the full capacity, and then only they will think of expansion. I have not heard of too many new industries or even expansion being set up. I don't know. Maybe I'm not aware, but others are aware. But there's been a lot of talk on it, but I don't see too many things on the drawing board right now. If it starts on the drawing board this year, maybe next year you will start having the credit expansion, and the DFI may also help in that direction. If that happens, then 10 to 12 is not a big deal. But if that doesn't happen, I think purely relying on retail, which could also mean that you're exposing the retail to too much of credit. And India has been very lucky that, unlike in the 2007-8 crisis in US, India has been lucky because the individuals are not were not indebted too much. Therefore, they could survive the crisis.
Right. In fact, a very important point that you made with regards to the credit growth as well, because if you see in terms of the past 2 years, the Indian banking system has actually been riding mainly on treasury trades as deposits soared and credit growth dipped sharply. If you see the gross and net NPAs has moved, well, they've moved south. The PCR, the capital buffers, profitability indicators, somewhere are back at pre-pandemic levels as well. So clearly, from here on, do you think it's mainly how the economic growth pans out for the country is what the banks will have to rely on?
See, banks today are really flush with funds, and they can give a lot of money. So there are two things which has to be seen. One is the demand from the industries. Second thing is demand from quality industries. Having burned their fingers up to 2015-16 with a lot of projects, of course, they all were very ambitious, and there's a huge projection of the growth in the economy in the first decade of the century and the first part of the second decade also. But all this led to a huge credit growth, and when the projects couldn't get completed on time, you had them converted into NPAs. So banks are a bit wary about it, and the fact that the government also recognizes the need for a DFI, which can actually fund for 20 years and 30 years. I'll just take you back to the good old days in the 60s, 70s, 80s, and early 90s. And you had the three DFIs, which played a major role, along with the three investing institutions. They used to finance about 80 to 90% of the project cost. Only about 10%, 10 to 15% of the project cost used to be funded by the banks. And they were primarily working capital bankers. But today, what happened is, because in the absence of the DFIs, the banks stepped in. Partly they didn't have the long-term funds. Partly they also didn't have the wherewithal to do the appraisal and then the monitoring portion of it. So I think with the advent of a DFI, and if more demand comes up, credit growth could be there. But I don't see too much of credit growth this year. But yes, all as I told you, the consumption-related credit growth, credit cards will go up because people who have been locked up at homes would like to go out and spend now. So that will be something. Travel will give a big boost. So maybe travel-related income, expenditure, revenues, and credit will go up. Now the flights are starting from I think Sunday or something. So those are all things which will go up. But industrial growth, I have not seen too many new licenses, new projects being announced, or even a major expansion being announced.
Absolutely. Very rightly pointed out that it's mainly retail, your services, agriculture, MSMEs, which are witnessing healthy credit demand. However, the real pickup in credit will be dependent on government spending as well as private capital expenditure. If that does not happen in its real sense, Mr. Kannan, and with that, do you think higher interest rates could trip the growth story from here on for a country like India?
Yeah, one thing, Hiral, there's a lot of misunderstanding saying that credit growth will get hampered if there is higher interest rates. No. So if the interest rates are higher, then obviously the returns, the inflation-related returns are also going to be higher. So if your input cost has gone up, then you're also going to pass it on to the customer to a large extent. Therefore, you will be in a position to recover it. It's only a question of demand. If there's a demand, if a person feels that if I manufacture a particular item, I can sell it at a profit. He will do it. And there's a lot of noise going on everywhere saying that, interest is very important. Interest is important, but it's not the most important is the demand. That is what I call the market. Second is the availability of raw material supply and uninterrupted power, all those facilities. If the demand is there, then automatically people start setting up units. And then, so we have had in the 80s, when the inflation was very high, the demand was very high. Interest rates were very high. If you recall, I don't know whether you were around, but the interest rates are around 17, 18%. But there's a good demand. Today, the interest rate is 5-6%. There's no demand. So unless there's a demand, there's no question of no issue, no question of any credit growth being hampered. Credit is demand. You can't go on saying, okay, I'll give you a 5%, set up a unit. Unless you feel that the product which I'm going to manufacture will be sold in the market at a profitable rate, it's absolutely foolish for anyone to borrow now, in case he feels that the demand is there. The one thing which is the government is doing is government is spending a lot on infrastructure, especially on roads and airports and facilities. That will be a boost, because that will also aid people in reducing the cost. If the roads are all faster, the fast tags and all, the transportation cost will come down. And to some extent, of course, now we have been hit by the oil price. That's another whammy. But having said that, primarily it's a question of demand. Credit cannot be created. There has to be demand. If someone wants money for a project which is going to do well, he will get it today.
Right. So with that, what do you make of the estimates that we have in terms of the gross borrowing for FY 2023, which is almost around 14.95 trillion rupees? That's higher. The repayments are likely to be higher as well. And so is the total liability of the center. And if you see the interest costs as well, the estimates that we have in terms of FY 23 are going to be higher basis the borrowing costs. How do you think that could impact the fiscal deficit side of it as well?
I see, the entire thing will boil down to what kind of revenues they can raise. See, one is the borrowing. If they are in a position to even maintain the borrowing as per the original estimate, I think they've done a good job. But for example, all those sale of monetization of assets and sale of certain companies, all those things, if they material. For example, LIC was to happen in March, but I think from indications it may spill out to the next financial year. That's a very big amount. And if that kind of things goes through, and if it's a success, in the past, there has been a mixed bag of response and results of the sale of such companies. Some of them have done very well, and the investors have been very happy. Some of them have done so badly that the investors will not trust those companies, similar companies. So we need to see how they are in a position to monetize, and they raise it. If they do that, and if they are in a position to maintain it, the gross borrowing had to go up, because the revenues are not so high in the last 2 years, thanks to the pandemic, because expenditures are not there. The only income they had was from oil, and there is no transportation, there is no entertainment expenditure tax. None of them they got any income. So see, India has now gone into expenditure mode tax. If you spend something, then you pay GST. If you don't spend, ghar mein baithe, all of us are all living very healthily, eating only kakadi and all those things, and not going in to the restaurants, affects the economy overall.
Absolutely. And then overall, with all of this, we're talking about fiscal deficit, etc. But again, inflation has been one of the major concerns right now that not only developing countries, but even developed countries are facing. So what's your view in terms of inflation versus the growth ratio?
Yeah, as I told you, there's a lot of fear that inflation is hurting everyone. Inflation hurts the people who are getting constant income, pensioners, people who are not having index returns, and it will really hurt them, because they get a fixed amount, and if the inflation is going to hit and the basic needs and social needs itself are not covered, they're going to hit. But inflation is also an attraction for the investors, people who have money, who can borrow and invest in companies. A little bit of inflation also gives an incentive for them to actually go ahead and market. So inflation is not a bad. Only thing is runaway inflation, which means today you're going to get impacted so badly that you may not be in position to recoup. But if it's a margin, that's why if you remember, even in India, we had this 4 plus or minus 2 as the target. America is now it's much lower at 2% plus or minus 1 or something like that. So that they are fearing that it might even be runaway inflation, because post the 2008 crisis they never actually increased the interest rates, and they had a number of problems with the change in government, with expenditures, and now subsequently the pandemic. Now all those loose money which has been put into the system is feeding into the system, and find that too much of inflation is happening, and they don't tolerate inflation at all. And that the government also is a bit worried, because inflation means the government will get affected, because they will be pulled up saying that they are not. Unlike in India, where the pension is fixed, there it's pension is related to the returns. So people have to be worried about inflation. But they will first tackle the inflation by spiking the interest rate, and they have already announced one hike, and and the way they're talking, it is almost going to be on tap interest rate hike. So almost regularly they'll be increasing the interest rate. So might go up to maybe around 2.5 or 3%, which means that the cost of funds will go up. The borrowing cost is, therefore there will be some slowdown in the economy, which is good for them. Whereas in India, we are now still at the bottom, but too much of money also is very bad. So that we need to kickstart the economy by having new industries coming up, government expenditure in industries, as also the private sector industries. If that happened, I think we are not worse off than most of the countries. All of them have the similar problem, but the problems in the East is, what you call, West is quite different from problems in the Asian countries are quite different.
Absolutely. And I think overall, it seems we could see a good picture from here on as well. But thank you, Mr. Kannan, so much for joining us on the show. Always a pleasure to get insights from you and your understandings. Thank you. Stay safe and speak to you soon again.
Thank you. And same to you. Take care.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.